Investing is a minefield if you don't know what you're doing. Many beginners are drawn in by the cool ads that they see online, falsely promising that they can make loads of money easily in no time at all. The reality is that investing will usually take a long time to build wealth, but most importantly, it can be done if done the right way from the very beginning. If done wrong, however, you will lose an absolute ton of money.
There is a major difference between stock trading and CFD trading, which we will get to. Unfortunately, it seems that CFD brokers have enormous marketing budgets, and beginner investors often come across these before they come across a proper investment platform. Without knowing what they are doing, they end up losing a small fortune and are put off investing for life.
With CFD trading, about 82% of customers lose money, with the average client losing £2,200. It's so bad that the FCA have been clamping down with the introduction of new regulations, such as limiting the amount of leverage. You'll notice on CFD broker websites large warnings about how many of their customers lose money. We think these warnings are great because it instantly tells us whether this is a genuine share dealing site or whether it's a platform we would want to avoid.
In this video, we're going to be talking about the difference between CFD trading and proper stock trading, why beginners should avoid CFD trading, and where beginners can go to start investing properly. Let's check it out. Welcome to MoneyUnshackled.com, the investment and finance channel that says you and your finances free. This is Andy, I'm Ben, and if you like what we have to say, hit the like button and click subscribe.
Also, don't forget to check out the MoneyUnshackled.com offers page, where we are proud to bring you hundreds of pounds in offers, such as free stocks with signing up to the investment apps such as Free Trade and Trading 212. We'll put the link in the description below. Let's get into the video. What is the difference between CFD trading and share dealing? The main difference is that with a CFD, you are speculating on a market's price without taking ownership of the underlying asset. Whereas with share dealing, you are actually getting ownership of the underlying stock.
Public companies have shares listed on a stock exchange, and with actual share dealing, you own those shares. A contract for difference, CFD, on the other hand, is a contract between a client and their broker. When you trade a CFD, you're essentially placing a bet against the broker without actually owning the asset. What you lose, the CFD broker gains.
That doesn't sound too bad, but it gets very dangerous, particularly for beginners, as leverage is often used. This allows the client to invest, or should we say gamble, money they don't have, which isn't too bad for an experienced client, but even then, the fees eat into your money. One of the worrying things about CFD trading is that the leverage inherent in the products means you could lose much more than your initial outlay. Also, in most cases, gambling is a fool's game. Don't get us wrong, we both enjoy a flutter, but we do this for fun, not to make money. But whatever you do is your prerogative.
With real stock investing, if you build a properly diversified portfolio and hold for many years, then the odds are massively in your favour rather than against you. Whenever we invest, we like to win, so it's great knowing that when we actually invest in a stock or fund, there is a good chance we will get a handsome return.
How do fees differ? We'd love to take you through a detailed comparison, but it's very complex, would be very time consuming, and they're always changing, and to be honest, we can't be asked. At a high level, the fees on a proper investment platform will be platform fee, buying and selling fees, small FX fee where applicable, stamp duty on UK shares where applicable, and fund fees where applicable. The great news is that tough competition is causing these fees to be squeezed, and in some cases they are now non-existent. Also, on the face of it, we think that these fees are much easier to understand than the fees applied to CFD trading.
For CFD trading, the fees might be spread or commission, overnight financing, this can really add up, expensive FX fees, guaranteed stop order, inactivity fees, withdrawal fees.
Example of CFD brokers. To avoid any doubt about what a CFD broker actually is, here's a list of some of the most popular ones. You've got Plus 500, IG, eToro, and CMC Markets, just to name a few.
Why beginners should avoid CFDs? People are at most risk of losing money when they are learning the ropes. It's obvious that an inexperienced investor should not be using leverage, i.e. other people's money, to invest with, as there is a high chance that they will lose a lot of money.
Short-term trading is notoriously difficult, which is why so few people can do it profitably. CFDs are designed for short-term trading. Most beginners, or even experienced investors for that matter, should stick to long-term investing to ride out the short-term market fluctuations.
CFDs are also more complex to understand, particularly around how the fees work. It's just too easy to incur higher fees because of a lack of understanding. Complex and often hidden fees are among the reasons why traders often lose money or make far less than they should have.
Is CFD trading always a bad idea? No. CFDs do have their benefits for those who know what they're doing. Personally, neither of us use them, but that's not to say that we wouldn't use them in the future. Some of the benefits include leverage. This is both a positive and a negative. For those that know what they are doing, leverage can be very useful to magnify gains.
Short selling. With CFDs you can bet that the price will fall and therefore benefit from a falling market. This can be useful for when you expect a market to fall but you don't want to sell your investments. You could use a CFD to hedge.
No stamp duty. Traditional share dealing in UK shares attracts a 0.5% stamp duty, which makes it very difficult to profit from short-term trading. As you don't hold the underlying investment with CFD trading, then you don't have to pay stamp duty, which makes it a lot easier to make money with short-term trading.
FCA crackdown is good. The FCA have been enforcing regulations on CFD brokers in recent times, which is great news. Not only does it force them to sort their act out and provide a better and fairer service, but it's also made some of them begin to think that their existing business model is in danger. As a result, we have seen some CFD brokers move towards offering a proper investment service, the most obvious being Trading 212, who now offer a free investing app which we've previously reviewed and think is great. IG is another example.
What investment platforms should beginners use? Choosing an investment platform is actually quite a complex subject, which is why it needs its own dedicated video. Luckily, we've already done several of these, so please do check out our channel page for more information on this. We've done videos on how to choose a platform, reviews on Interactive Investor, Freetrade and Trading 212. If these don't interest you, other platforms include Hargreaves Lansdown, AJ Bell, Vanguard, Barclays, IG, just to name a few.
As a reminder, we have some great offers where you can get a free share when you open a new account on some investment platforms, including Freetrade and Trading 212. So please do check these out on the offers page at moneyandShackles.com.
Question of the day, do you avoid CFD trading? And when you were a beginner, did you accidentally start with a CFD broker? Let us know in the comment section. Thanks for watching! On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyandShackles.com. See you next time.